stuff, but he's retired, still making $300,000+ a year. But every year, now that he's learned it, he tries to max it out as much as he can. And it just keeps working. Any questions? I always ask, what rate of return did the bank make on this money? So let me ask you, this young lady, what rate of return did the bank make on this transaction?
Like 600. Instead of six, it's 6 times 100.
Actually, it's because it didn't cost them anything, it's 200%.
Yes, but it didn't cost.
So how many times do you want to make 200% on your money? This way. So it's an interesting concept. So we have a lot of different scenarios. You're thirsty, you want to get a bottle of water, costs you $1, you pull it out, depreciating asset, because as you drink the water, there's less and less until it's empty, which means it's worthless unless you get the refund for recycling. But if you do it this way, you get the money from your better bank, also a depreciating asset, but you end up making a profit on the transaction. It's on what you do continuously, and it works and works and keeps working. And this is another scenario of a Bank 2 contract system. Like I mentioned to you, the bank, once they have your money, they can do whatever they want with it. So in this scenario, they give you 2%, pay you $2,000. Instantly, they'll lend out $40,000, but they charge 10%. So look at the profit they make on a fraction of that money. So when you look at all these variables, you start changing and doing what we're trying to coach people to do in a much better way. Here's a typical transaction. A consumer, once they deposit, they can deposit, withdraw, or borrow money. A lot of times you can use your bank account as a collateral for the money. So you still earn a little bit, but they're going to charge you a lot more money on the money that you borrow. So here's a scenario. When you deposit your money in the bank, what does the bank do with it? So we just try to turn tables because we have the vehicles, we have everything structured. We just want to make sure that we structure it in the right way, because when I first started doing this stuff, I didn't really understand all the variables, but then most of the people that I set up in the early days maxed it out, so they had to wait the next one, till the 12-month cycle was up to be able to put more money. So I ended up having to sort of work it out for them so they could do that. But now I give them the variables. In some cases it could be $500 a month, but it could be $5,000, a lot of flexibility, and it's worked out a lot better because once they start understanding the cycle of how to use the money, it works really, really well. And like John mentioned this, when you buy Starbucks, you want to use your bank or you want to use somebody else's bank. If you use your bank, you're making a profit. If you use somebody else's, they're making the money on you. So we do this every time you buy gas, buy lunch, groceries, travel. And most of the credit cards that you get, if you get like the Costco Citibank, on gas they give you 5% back. On travel and all the other stuff, it could be anywhere from 1 to 4. That alone makes me thousands of dollars tax-free because they don't send you 1099. So it's a great concept to be able to make a profit at paying your bills one way or the other, and it works all the time. So one thing you have to understand, banks and insurance companies control all the money. But banks have failed because of the way they do things. The insurance companies have never failed. So your money is in a lot safer place when you need it. Just like, for example, back when the market crashed in '29, Babe Ruth was one of the only professional athletes that had money with an insurance company. All the other athletes went broke, and he was able to continue. And so a lot of people use this story when they're trying to promote this kind of product. So the better bank account concept basically allows you to create wealth, and I've seen it happen. And if you really do your homework, the Rothschilds, the Morgans, the Kennedys, and so on, they create a system. And the reason generations keep building more wealth is because they follow this system. And if it's done right, it'll allow you to control the money. Then the death benefit, every time there's somebody in a member dies, it increases the value so they have more money to feed for the next generation. So here's the traditional cycle. When I tell people, this is what you do every single day. When you spend money, you pay your bills and do whatever, as soon as the EFT clears or the check clears, that money is gone and you'll never see it again. So what we try to do is use the OPM factor on anything you ever buy. It's always better to put the money in first and then take it back out. That way you never stop earning on the account. When I buy cars, this is all the tools that I use. I always implement this because I built enough money in this account. And it always keeps working. I've paid off mortgages, I paid off cars, I paid off, I hope my kids, my grandkids. Always doing this because it never stops working. Just like I tell the story about my son, 2 years ago needed money to pay off his student loan, credit cards, car, motorcycle payment, total of $70,000. 2 years later, and I asked him, how much can you afford to pay? And I'm going to charge you 0 interest. And he says, $500 a month. I said, oh, set it up from your bank account. Every month it's going to go into this to pay back your money. In 2 years, the account's grown to over $23,000. So I paid off the debts. It's still working. So I've seen it work time after time. It's a much better tool because the system works. We have it figured it out. You just have to follow the variables that we coach people of anywhere from 20 to 25% buffer. And if you do that, your bank will be fully funded probably in a 5 to 6 year period instead of the 8 of the example that John was looking at. So that means that this thing's going to work much better as you continue to develop it and keep building.
The insurance, like it's